Make your first $1,000 with options, even if you're a complete beginner and don't know what options are. Options have a reputation of being difficult, but the truth is they're mostly taught the wrong way. Once you understand how they work, you can have one-day trades like these, or longer trades that can literally double your money, which is what I'm going to teach you in this step-by-step course. But first, you got to start with step one. What is an option? An option is a bet between you and another investor. You're betting on the future price of an investment. If it goes your way, you make money. If it doesn't, you lose money. The bet is made official through a contract that outlines the cost to set up the bet, your goal price, and the expiration date. But here's the magic. With an option, you're buying the right, not the obligation to make that bet. If you don't want to go through with it, you don't have to. Kind of like a reservation at a restaurant. Just because you booked it doesn't mean you have to show up. You always have the choice. Here's a real-world example. This stock is trading at $35, but you think it's going to hit $45 next week. In order to make that prediction, it's going to cost you $10. Now let's say you bought that bet. If you're wrong, you're out $10. If you're right, you actually profit $1,000, minus the $10 to make the bet. That's because you bought the right to buy 100 shares at $35 and sell them at $45, making you $1,000 in profit. But that sounds too good to be true, right? The choice to make an investment only if you're going to make money? You'll understand exactly how to make money in a minute, but we need to pump the brakes real quick. This can get overwhelming, so let's start slow. Dip in a toe first, take it easy. We'll start with the basics using analogies and animations, slowly wading into the water, driving home how options work in the real world. Then we'll get into the exciting stuff. But before that, we gotta cover step two, understanding puts and calls. Buying a call is a bet that prices will go up. Buying a put is a bet that prices will go down. Now, it can be hard to remember which is which, so here's a dumb trick I invented. When buying an option, I actually look at the words put and call. I think of the U in put and the A in call as arrows. The U in put forms an arrow pointing down, so buying a put means you're betting the price of an asset will go down. While the A in call forms an arrow pointing up, so buying a call means you're betting the price of an asset will go up. That trick works for buying options. Follow the natural direction of the arrows and you won't be led astray. But we can also sell options. Here's how you can remember what those mean. Selling is going against the grain. So when selling a put or a call, we simply turn the words upside down before again following the arrows. So we have a call option. Buying a call option is a bet that prices will go up because of the arrow. Selling, we flip the word upside down and follow the arrow. So selling a call is a bet that prices will go down. The same goes for put options. Remember that buying a put is a bet that prices will go down. But if we're selling a put, we flip the word upside down and follow the arrow to see that selling a put option is a bet that prices will go up. I highly recommend screenshotting or drawing this graphic to use for reference in the future. It's dumb, I know, but I swear it works. So now that you know the terminology, let's go back to how much options can actually earn you. Those massive profits from earlier are actually from an institutional investor coach of ours, Eugene. Of course, not everything is a win, but it's insane what he's capable of. And by the way, our investment group will be linked in the description. There you'll get access to Eugene and other coaches just like him. In fact, I'm so confident in our service that we're offering 7 days free. After that, you can stick around for as little as $10 a month. Just make sure you join ASAP because we actually limit spots every single month to ensure that everyone gets the help that they need. Okay, so how's the water feel? Good, not too cold, not too warm, a real Goldilocks porridge situation? Great. Well, let's go a little bit deeper, and we'll use a far-fetched analogy to really drive the explanation home. Let's pretend you smoke flower. For some of you, I know that's going to be a bit of a stretch. So let's say that your local flower dealer is really into the derivatives market. Oddly specific, I know. But you didn't think it was a woman. She allows you to pay a little today for the right to buy your grain at a specific price next month. Today, flour is $10, but inflation is getting out of control, and who knows what it's going to cost next month. So she allows you the option to buy your goods next month at $12.50, guaranteed. If you think the price is going to increase to more than $12.50 in that time, this is a good deal. You need to lock in that price. But if you expect the price to stay the same or drop, then you shouldn't take the deal. The dealer's selling a kind of call option in this case, like a stock option, but instead done in the alleyway behind the CVS. Let's say you take the deal. You'll have to pay a small fee upfront called the premium.
Premium! Dude!
In this case, we'll say the premium is 50 cents to enter the deal. Now what happens next? There's two scenarios. First, let's say hyperinflation does kick in and prices rise dramatically. The dealer needs to sell for way more than $12.50 to her normal customers. Well, you just made an awesome deal. The poor small business owner will lose money on the OG purple skunk hazy kush that you are going to buy, but that's not your problem. Now, what happens if the price stays the same or decreases? This is scenario 2. So let's say the price stays right at $10. This is where the beauty of options really kick in, because you don't have to buy your bud at $12.50 like the option outlined. You can just cancel the contract by letting it expire. Now, you might be thinking, that sounds too good to be true. And of course, yeah, there is a catch. Remember that premium that you paid for the right to the option? You lose that money whether you take the green recontract in a month or not. So if the price stays the same at $10 in a month, you actually do lose money, your 50-cent premium. The price of the premium can change dramatically based on a few factors that we'll discuss in a minute. But it's important to remember that when buying a call option, a bet that prices will go up, the most you can ever lose is the premium, no matter what happens in the market. A company behind the stock could go down in flames, or Bitcoin could be worth less than a single nug full of seeds and stems, and you'd be safe because you can choose to just not exercise that option. Look at this diagram of buying a call option. You can see no matter what, you start with a loss. That's because of the premium fee you must pay in order to get the option in the first place. You begin to make up that loss when the asset reaches the agreed upon price of $12.50 from that example earlier. You will be in the negative until that 50 cents premium fee is then covered. Beyond $13 is where you start racking up profits. If the price were to go to $15, you would have made an awesome deal. Now in real life, your returns would actually be much higher because options contracts typically deal with at least 100 shares at a time. In fact, options can make a ton of money off of a small investment if done properly. We'll discuss how exactly you can do that just a little bit later, because first, let's do one more non-bud related example. We're wading into the pool a little bit further. The water's up to your upper thigh. It's a little chilly. Okay, let's imagine you're buying a call option today for 1 Bitcoin with a current price of $30,000 and a strike price of $35,000. By the way, the strike price is a set price at which a derivative contract can be bought or sold the moment that you can strike. This is important because remember, an option gives you the option to buy or sell an asset at a specific future price. That asset needs to hit the strike price before you can exercise or use that option. This is what's called being in the money. It means the strike price has been met and you can exercise the option if you wish to. For call options, strikes higher than the market price are said to be out of the money. So let's reset this. We're out of the money in our example right now because the market rate is $30,000 for 1 Bitcoin, but the strike is $35,000. So again, if Bitcoin moved up above $35,000, we would be in the money, ready to strike. Okay, back to this full example of buying a call option. Bitcoin's market rate is at $30,000. Strike, $35,000. You've got a month to exercise the option and it costs $500 to arrange. If Bitcoin drops to $25,000, then well, you're out $500 because the deal isn't worth it for you. In fact, if Bitcoin drops to $20,000 or $10,000 or $3.47, you're still only down $500, the price of the premium. But what if it rises? If it goes to $36,000, you'll get a $1,000 profit minus the $500 premium. If it goes to $45,000, the profit is $10,000 minus the $500 premium. If it hits $100,000, then this will be you.
I'm gonna buy the entire earth and be king.
Now, in order to take home your profit, you either need to sell the contract to someone else, now that it's in the black, or you can actually buy the Bitcoin. Let's say Bitcoin went to $36,000 on your $35,000 option. Upon exercising your option, you would be buying an entire Bitcoin at the discounted price of $35,000. This means you could buy the Bitcoin immediately and then sell it, pocketing your $1,000 minus the $500 premium fee. Buying call options like this, betting the price will go up, is the most common approach for retail investors because they're the most simple and they can be low risk if done correctly. So now that we understand the mechanics of how this all works, let's get into some real world examples. We're going deeper into the pool from your upper thigh to your, I'll just say it, your groin. Your groin is in the pool. Options have been available in stocks for years, and now they're becoming more and more popular for cryptos. While they generally work the same, there's a big difference in volatility. Since cryptos are known to swing wildly in price, that means that the premium fees are higher, but they can also be quite attractive for short-term strategies. Looking at the Bitcoin price chart, any of these steep climbs would have made fortunes with call options. Just like with comedy and juggling, the secret is in the timing. Okay, so you like the look of options and you want to use them on the stock market. Well, research is the key. Since we're looking at buying a call option, you want a stock that has the chance of going above the strike price in the agreed timescale. Let's assume you've done that research and chosen a stock. I'll be using the Webull stock brokerage to set up this option. I find them easy to use, and if you open an account, you get a bunch of free stocks, so that'll be linked down in the description if you want to check them out. Now, after signing up, search up the stock ticker that you want. Choose the options button at the bottom of the screen. Now you get a bunch of numbers, but don't panic. I know it's a little bit freaky. Click that little arrow up on the gray date bar. This brings up all the available contract expiration dates. Now you can flick between expiration dates to see the full list of your alternatives and choices. We're going to click 21 days out. You might have to scroll down a bit to see the current price of the stock. You can see that that's in the red row. The strike price is written in white text right in the middle. Remember that this is the price where essentially something will happen if it hits that price before the expiration of the contract. And it's really important to note that calls are on the left and puts are on the right. We're doing a call or a bet that the price will go up. So on the call side, you'll see bid and ask. This is essentially the going market rate for a call option on this specific stock. But remember, with stocks, you need to multiply that by 100 because we're always buying in groups of 100 units. So if we click on one and then go to market order, we can see that in order to buy a call option of 100 shares of Palantir, we would have to pay $45. Then if we click the single option button up top, we can see the break-even price of $8.97 per share and maximum loss of now $47 because the price just updated from 45. Let's put this on our chart from earlier. If this stock goes below $8.50, we lose our $47 premium. If let's say it goes to $10, we make $103 in profit on a $47 investment. That is $10 times 100 shares minus $8.97, the break-even price, times 100. This means with a $470 investment, you would make over $1,000 in profit trading options. That easy. Once the contract is at a price you'd like to take profits on, you can either exercise it or sell the contract itself in the open market for a nice chunk of change. Then all you need to do from there is take an obligatory screenshot and post it to Wall Street Bets. For dealing in crypto options, it can get a little strange. We're up to our neck in the water now, so tread carefully. Bybit is the best site I've seen for crypto options. Plus, they have an offer for a $50 bonus when you use that link in the description and deposit $1,000. So you'll need to make an account and then fund your derivatives account with USDC, the stable coin, and then go to the derivatives drop-down menu, and from there click USDC options and Bitcoin options. Here we have an options page with contract expiration in the middle, calls on the left, puts on the right. Let's say we think Bitcoin is going to shoot up in a few days. We could buy a call, a bet that prices will go up, by scrolling down to find our desired expiration date. We can see the current price is $16,600, but we think it'll go over $17,500 by the 18th when this contract expires. So we click that contract on the call side, and then the right-hand side pops up with even more details. Now we're going to go to market and type in 1 Bitcoin here for the sake of simplicity. Now that it's calculated, we can see to make the bet that Bitcoin will hit $17,500, we'll have to pay a $229 premium. And what I love about Bybit is they actually show you a profitability chart if we scroll down. So here we see our maximum loss is the premium fee. This is rounded to the nearest $5. Our break-even point is $17,720, and then above that, it's straight profit. Now, if all looks well, you'll simply click place order. As you can see, it's pretty simple and straightforward for non-Americans, kind of like healthcare. And don't worry, I'll show you a workaround on crypto options for US users a little bit later, because first we need to go back to that Bitcoin example from earlier. We have another exciting way to make money with options. The difference here is now you're on the other side of the deal, selling a call option. When selling a call option, you're betting the price will go down, a real negative Nancy. If that happens when the contract closes, you get to pocket that nice premium fee. But the loss can be massive if the price instead keeps on increasing. The current price is $30K. You sell a call option for a $500 premium and a strike price of $35,000. You are in the profit zone all the way until Bitcoin hits $35,500. After that price is where losses start, and they are theoretically unlimited because as the price of an asset goes up, you lose more and more. If Bitcoin were to go to $100,000 where the contract is then executed, this means you just lost $64,500 having to purchase that off the market in order to give it to the buyer. Now this happens because you only got paid the $35,000 strike price plus the $500 premium, but you had to purchase a $100,000 Bitcoin. Now this isn't very common. It's called a naked call since you sold a call option where you didn't actually own the asset and therefore you exposed yourself. It's super risky and like other forms of naked calling. I wouldn't recommend it. Much more common is selling a covered call. This is where you already own the asset, so you're covered. So in the Bitcoin example, if you already own the Bitcoin, you would be selling your $100,000 Bitcoin for $35,500, which is annoying to say the least, but you wouldn't actually be out of pocket anything since you already own the asset. Again, this is an extreme example. Most of the time, this is a very reliable way to earn passive income on stocks and cryptos that you already hold. Typically, an investor would sell a covered call at a price that they think is unlikely to be hit. That way, they can just keep on collecting the premium fee over and over again, essentially leveraging their asset for passive income. And it can be a really awesome way to earn money on assets that are just sitting there. Let's go back to Webull and do an IRL example of selling a covered call. And this is important. If you're looking to sell a call here, you need to first own 100 shares of that asset. So you need to buy some if you don't have 100 shares yet. Remember, this is generally used to earn passive income on assets you already own, that is covered calls. I have 100 shares of MetLife, so I'm going to use that for this example. On the stock page, click Options, click the gray date bar in the middle, that's where it says 4D. That will collapse the view showing you all of the possible contract dates. You'll choose the time frame that makes the most sense for you. I'm going to go with 32 days out, so I tap 32D. We now see all the calls and puts for that expiration date, but we're selling a call, so we're going to just focus on the left side right now. Remember, when selling a call, we're betting that the price of our asset will go down. That's how we make the most money. Here we can see the current price in the middle is around $66 per share. If we sell a covered call at the $70 per share price and our asset doesn't hit $70 before it expires 32 days from now, we get to keep our shares and collect that juicy premium fee. Let's click on the $70 contract. Then we'll click sell. At the bottom, we can see the credit is $95. This is the premium fee passive income we'd collect if we sell this covered call and in 32 days at expiration, the share price hasn't reached $70. Here's what it looks like charted out. You can see that the break-even point for the $70 strike price is $70.95. The 95 cents comes from the $95 premium divided by 100. If you like the way that looks, just hit sell on the app and you're good to go. Now, $95 in this case isn't a ton of money because it's very low risk for you. A share price of $70 for MetLife is almost 10% higher than the current share price at around $66. So it's not super likely to break $70. And even if it does, it's not really that big of a deal because you'll still get that nearly 10% gain plus the premium fee. So let's look at a riskier, higher paying option. Going back to the main options page, we again see the current price is $66. A much riskier bet would be to say we think the share price will be significantly lower than $66 32 days from now. Let's say we really think the price is going to fall in this company and we want to sell an option at $55. So we're going to click the call option at $55, which brings us to the contract page. Then click sell, and we can see the premium passive income here is much higher at $1,130 for the exact same amount of shares. That's because we're taking on much more risk. If the current share price of $66 stays the same for 32 days with this contract, when it expires, we'll be forced to sell our shares at just $55, a loss of $11 per share. Not good. Here it is charted out. You can see you're losing profit from your premium at any price above $55, and your money turns negative when the share price passes just $66.30. So unless you really think price is going to collapse, it's much safer to choose a covered call price above the current share price, like that $70 option. That way you can just collect the passive income premium with relatively low risk, and you don't have to stress, and you'll get good sleep at night. Again, all of these examples are being done on Webull, which is linked down below. Okay, so now that we've covered calls, get it? Let's talk about buying put options. Remember, if you buy a put option, you are betting that the price will go down. Practicing this can be a great strategy because you can earn massive profit while your downside is limited once again to that premium fee. Going back to Bitcoin, the current price is $30,000. Strike price, $35K. We're paying a $500 premium fee. If Bitcoin goes down to $20K, we profit $15,000 minus the $500 premium. If Bitcoin goes up to $35,000 or $50,000 or literally to the moon, the most we lose is still $500, aka the premium! Real world example, this is super important. Let's say you think Apple stock is going to decrease in the next few days. Instead of shorting the stock, you could buy a put, because again, the most you can lose is that premium fee. On Webull, we're going to search for Apple stock. Go to options, and we'll leave it on 4D, which means contracts expiring in 4 days. The current price is around $142 per share, but we think it's going to drop to the 130s. That means we can buy a put and profit if we're right. I'm going to click on the $139 contract on the right-hand side under puts. Here we can see the premium fee is $116. That's how much we'd need to pay for the right to profit off Apple shares declining in price. Putting this on a chart, we can see the current price is $142. The strike price is $139, which means anything under $139 is when you start earning your $116 premium fee back. Your break-even point is $137.84. If Apple falls to anything less than that when the contract expires in 4 days, you've made an excellent trade. Great work. You figure out your break-even point by taking the premium fee divided by 100 and subtracting that from the strike price. If you're new to options, I highly recommend drawing out these little charts before making any purchases, because it makes it so much easier to understand what needs to happen in order to make money and the circumstances in which you lose money. And again, in this example, you're betting on Apple going down, but if you're wrong and Apple goes up in price or stays the same, you simply lose your $116 premium fee. Selling a put option is the opposite. You are betting the price of an asset will rise and selling that bet to someone who thinks it will fall. The most you can make when selling a put is the premium fee. The most you can lose is quite high, the total price of the asset. Back to the example. Current price is $30K, strike price $35K. We're receiving a $500 premium fee. If Bitcoin goes to $35,000 or anything higher, you will simply collect your premium fee and be on your way. If Bitcoin drops to say $20,000, you will lose $14,500, which is the $35,000 strike price minus the current price of $20,000 plus the $500 premium fee. Let's do another example to really massage this into your brain. You now think that Apple stock is going to take off because you just heard a rumor. You just heard that their new virtual reality headset is so good it can trick you into thinking that you have friends. You're bullish and lonely, but you're mostly bullish. So you're selling a put. To do that, go on Webull, go to markets, and then search for Apple stock. Select options, collapse the date menu by pressing where it says 4D. Again, all of these rows are various contract expiration dates. Let's go with 18D. 18 days out for these contracts before they expire. And remember, this is a put, so we're looking on the right-hand side of the screen. And we think the price is going to go up. It's going to go up from that current price of $142. $145 looks good, so we click on that on the put side. Switch it to sell, and we scroll down to see a premium credit of $680. That's how much we would receive in profit as long as Apple shares are any price above $145 18 days from now when this contract closes. Looking at it on a chart, we can see the current price is $142, so we're not in full profit yet. And we can see the line goes flat on the top. That's because the most we can possibly make when selling a put is the premium fee. fee. The most we can lose when selling a put is a lot. In this instance, we start losing money as soon as the share price hits $138.20. We get that number by taking the strike price and subtracting the $680 premium fee credit divided by 100, because a contract is 100 shares. So a $145 strike price minus $6.80, which equals a break-even share price of $138.20. Now again, this is a great strategy to understand, but please be careful when selling a put because of that downside risk. Now, hopefully you're still with me. If you're not, there's no shame in going back and watching the last 10 minutes again. I actually recommend it just to really firm up what's going on in your brain right now. I spent hours and hours staring at graphs in order to understand this stuff. I mean, I had to think of turning letters into arrows, for God's sake. And you might be wondering, are options even worth the hassle? You're damn right they are. Once you really understand options, you can do all sorts of cool things, including making passive income and even take strategies to protect your portfolio. These are great ways of making money if you know what you're doing. The first advantage I want to mention is leverage. Options multiply the power of your money. Let's go back to the Bitcoin example. You could buy one Bitcoin at $30,000 and hope for the price to increase, but this would cost you $30,000 to own the asset. Or you could pay the much smaller premium for buying a call option, which sneakily has the exact same profit potential. I know which one makes more sense for me. For a relatively small outlay, you can massively multiply your cash. It also keeps you safe from market crashes. Say you've got an option to buy Apple stock, and then every single iPhone on the planet bursts into flames. For some Apple users, sadly, they'd still want one, but for most, it'd be disastrous. The stock price would plummet, everyone would want to sell, and no one would want to buy. But since you only have an option to buy the stock, not the actual stock, you're protected. There's a heck of a difference between owning 100 Apple shares and having the option to buy 100 of them in this situation. With options, you just walk away if there's bad news in the market. You've got way more flexibility. Now, I mentioned earlier that there's a secret workaround on crypto options for US users. I'll have them linked down below if you want to try them out. But this works the same way as options, except it's a bit more user-friendly, to be honest. In this example, you're essentially saying, I'm happy to buy Bitcoin at $27,000. This is a version of buying a short put. If it indeed goes below $27,000 when the contract closes, I will receive Bitcoin at the $27,000 price, plus the premium settlement fee, which in this case is 0.05%. That's the one-day return. If the price stays above $27,000, I will buy no Bitcoin and just receive the premium fee in USDT. Then I can just do this again and again and keep on collecting fees until the contract settles. The reason for the settlement fee is I'm taking on a little bit of risk. So let's say Bitcoin falls to $26,000 when the contract closes. This means I'm buying $26,000 Bitcoin for $27,000. You're not exactly losing money, but you are getting a worse trade. On the flip side of this, you can put up Bitcoin and earn a premium if you think that Bitcoin won't likely rise, essentially selling a covered call. What this is saying is I hold some Bitcoin that I'm okay with selling at $30,000. However, I don't really believe that it'll go to $30,000 in a day. If it does stay below 30, I will keep my Bitcoin and collect a nice 0.37% fee in one day, which is 200% annualized. If the contract settles above 30K, I will sell my Bitcoin for 30 and still collect the same fee. The risk here is if Bitcoin goes to 31K or higher, I need to sell for 30. So this can be a way to both hedge your portfolio and earn passive income, and the strategy really can be as risky or as safe as you like. Again, kind of like healthcare. Let's quickly cover the downsides to options because, of course, nothing is perfect in life. Other than my incredibly perfect fans, who would love to take this opportunity to hit the subscribe button down below. The main thing I want to mention here is premium costs. Be wary of them. Premium, dude! The premium can get quite expensive, eating away at your profits, and the price of that depends on three things. First, the expected volatility. The greater the expected volatility, the higher the premium. This is why crypto premiums are often more expensive than stocks. Second, the length of time. The more time you want to give the price to change, the more you have to pay, and this makes sense because there's just more time for that price to be hit. And third, the smaller the difference between the spot price and the strike price, the higher the premium. Again, because it's more likely to occur if that difference is small. And again, if you don't exercise an option at all, then it's money down the drain. So this strategy can take a little getting used to. Start small, and once you get the basics down, this is a skill that you can take with you for life to earn passive income and really leverage your investment dollars. So let's just finally dunk your head underwater, and congratulations, you've been officially baptized into the exciting world of options trading. Again, if you're looking to learn more in-depth strategies regarding options and investing, check out our members-only group, Finova, linked in the description below. There you'll find stock and options coaches, crypto coaches, trade signals, buy alerts, and much, much more. It's a must join. Or if you're looking simply for another tutorial, I highly recommend this video where I break down the fundamentals of technical analysis. I'd like to thank you so much for watching. I'm Max Maher, and I hope you have a profitable day.